I'd like to welcome everyone once again to the third lesson in our Market Profile Beyond the Basics course. As usual, before we begin, we need to quickly review the disclaimer. Trading and investing involve high levels of risk. Future results can be dramatically different from the opinions expressed in this course. Past performance does not guarantee future performance. The presenter may or may not hold positions in the financial instruments discussed. Our third lesson in the course is titled Order Flow Tracking Using Footprint Charts. And even though we will not cover all the aspects of order flow tracking and the different elements of the footprint charts in this lesson, this is our first lesson where we will actually begin to talk about, discuss, and introduce some of these concepts so we can begin integrating them and using them in the trading strategies and the various applications of the profile that we will look at together. So today's lesson will discuss really some of the basics, and we will look at some of the preliminary strategies, analytical tools and techniques for tracking order flow, but certainly we will get into it in much greater depth and greater detail in other lessons as well. I say that at the beginning because I know that this is a rather confusing and difficult area for many people, especially those who are not familiar with the process of order flow tracking, and I didn't want you to think that a subject as intricate and as detailed as this one would all be covered in one lesson, or that you would try to sort of learn all that there was to learn from this one lesson. We will certainly spend additional time on it, and we will look at a number of different things relative to footprint charts and order flow tracking. Now, typically, at the beginning of each new week in the course series, we will do a review of the concepts that we have covered in the previous week, and I also like to go over the exercise that you had, and I think that this is a very important part of the educational process because it gives you an opportunity to apply the concepts in real time in live markets, and it gets you on the track of thinking, how do I use this information? How do I put it into use? The things that we talked about during our last week lessons had to do with using the profile to identify and learn about market sentiment, using the profile to also learn about market momentum, and using it as a tool to trade in harmony with the market and market activity. So let's take a look at our practical exercise and answer some of those questions together. What does the chart tell us about market sentiment? So if we look at the prior week, what does the chart here for the prior week tell us about market sentiment? Was the market bullish? Was the market bearish? Well, let's take a quick look at it together and analyze and see what happened. We have a cluster of activity here, and what happened after it? A quick jump, another cluster, and another cluster. And here we actually have two small clusters close to one another and a very tiny area of development here. But what was ultimately the result of this activity? Obviously, it pushed prices higher, and this activity higher yet, and this activity again higher and higher. So just by looking at this profile, you should know right away that the market sentiment in the market is very bullish. That's from studying the profile and the development of the profile. This is a very bullish looking profile. There are a number of other things that you want to hone in that will help you come to that determination. Naturally, the prior week made a higher low than the week that preceded it and a higher high, which is again typical of an uptrend. Not only that, if you take a look at the way the profile looks, once we finished this intense area of activity, we seem to be jumping higher and higher very quickly. Look at these areas of underdevelopment here. The reason that we didn't have much activity here, the market just didn't have time to waste to spend trading in this area, jumped higher and traded for, again, look at how small the cluster is, for a short period of time, and then continued on. Again, we have another valley here, and the other cluster was very small. It didn't really begin to rest and find a stopping price, if you will, until up here, and this is the new rotation, or this is the new normal distribution for the week. So the distribution up here is much higher than all the others, and we end up closing close to the high of the week. And look at the value area high way up there, and this is the value area low. So when you analyze the weekly profile, trying to get a gauge on market sentiment, those are the types of things that you look at, and hopefully when you did that, you came to the same conclusion that I just described. Does the profile indicate trending or non-trending? Well, we already talked about a higher low than the prior week and a higher high, so that is the definition of an uptrend. We're making a higher low and a higher high. Not only that, take a look at the trend of where the clusters are moving. One cluster above the other, this one here and this one here, for a close close to the high. That is a very strong trending market to the upside. So we had a very bullish market that week. Does the profile show a bullish or bearish close? This is an interesting question. Now notice, we close above the volume point of control, both for the TPO and for the time price opportunity point of control, as well as the volume point of control. We are closing in the top half of the range, and not only in the top half, but in the upper quarter of the full range, or the top half of the upper half. So this is very bullish up here, closing very close to the high of the week. That is a bullish close based on the development of that week. Bullish close. Now, would you prefer to buy valleys or sell peaks in the following week? Based on the sentiment that you've detected and the trend in the market, your answer should be, I would like to be a buyer of valleys, meaning anytime price drops to these types of areas, I would be thinking about buying. Again, here would be another one. Certainly if the market ever came back to visit this area, this is what I would like to be buying rather than selling the peaks, because of the strong bullish sentiment in the market. And here is another beautiful area where we hardly had any development. Once again, this is a very strong area of support, and at some point it will be tested, and we will see if that buying pressure, or these strong buyers that were here, are still present or not. So I would be a buyer of valleys rather than a seller of the peak. If we were to describe that style of trading, we would say that this would be trading with the trend and also trading in the direction of momentum. When you do that, when you trade in the direction of the trend and in the direction of momentum, you increase the probability and chances of your success. So I could, in fact, choose to take some shorts in this market, but they're likely to be short-lived, and no pun intended here, and at the same time, the probability of their success is going to be lower, so I'm really fighting an uphill battle. So why not stay with the trend and stay with momentum? I know that many traders say we ought to play both sides of the market, but whenever you have such a strong trending market to the upside and such strong momentum, you really don't want to stand in front of it and be on the opposite direction of the market. And quite often, it is good not to be greedy. If you can make the money buying the valleys, you shouldn't also be trying to sell the peaks. Be content with your gains and stay on the right side of the market. That is good advice that will keep you out of trouble and will help you to maximize your returns. Who has momentum in the market? Obviously, the bulls have the momentum in the market. We wouldn't have this kind of a bullish profile unless the bulls had the momentum. Again, look at all these areas we just skip right over because the momentum is so strong. This is how we gauge momentum. So really, in the prior week, we didn't have the strong bullish momentum that we had during this week because we don't see as many of these valleys as we do in this particular week. This is how we gauge momentum on a profile chart. A trader feels that since this market has been trading at an all-time high, the smart play would be to short the market. Now, I run into this all the time. Oh, that's gone way too high. It's much higher than it should be. The market is oversold. Who are we to tell the market whether it's oversold or not? As profile traders, we want the market to tell us what we should be doing. We're not going to impose our will or our projections or our prognosis for the market. We need to see what is the market telling us and respond accordingly. And we just went through an exercise that told us the market is incredibly bullish. So what would you think about this trader's recommendation? I'd say thank you very much. I'm not going to listen to anything that you have to say. I'm going to listen to what the market is recommending and what the market activity is telling me. So there is no such thing as we've reached a too high of a high and I should start shorting the market. Based on last week's activity, what are your potential projections for the market? All right. Now, herein lies one of the analytical processes that I really want to share with you in these lessons, and that is to begin to take a look at the market, analyze it, and project. Here's what I think is likely to happen. And then as the market begins to develop, you need to take a look and see, is your projection on track or not? This helps you, again, to stay on the right side of the market, and it helps you to get out quickly if, in fact, things are not developing according to your projections. So a reasonable projection for us would be that we're going to have another bullish week next week. Perhaps the market may dip back for a retest of this point of control because we are somewhat close to it, and we are below the half of this upper half that we just discussed. And in addition to that, the market could also roll all the way back to come back to this valley here for a retest of that valley. All these are potential scenarios for the next week. Before we continue higher, the market may decide it wants to reaffirm the support levels that were created during this week, which then becomes the prior week for next week before it starts moving higher. If in fact the market gaps up, let's say, and decides to move quickly higher, then certainly I would expect the market to continue above the close with a range, at least average true range for the week, and that should be in the neighborhood of about 35 points higher. So that would be my projection. We could be moving in this direction for a little bit for a retest, and then after that we may be pushing higher, and that range could span from here to here. If in fact that's the case, I would reasonably say somewhere in the neighborhood of 35 points. It could of course be greater, it could be a little bit less, and that's just a projection. And the projection is based on the average true range for the week and what is likely or what might happen if the market decides to go back and retest some of the levels that were established in that prior week. All right, we switched the slides and now we're looking at the market with our powerful analytical tool. We have the market profile on the candlestick chart, and this time our candlestick chart is a 10-20 minute candlestick chart of the ES Mini. So each of these represents one session. one session for the day followed by an evening session. So, and actually the first session is a whole week. The next session is another week, and this is the third week. And each of these candles represents either a day or an evening session for the week. Now, this is what the market looked like at the close. So in reality, this profile right here is the very same profile that we were looking at in this slide here. So this week is how it looks if we put it on candlesticks. And you begin to see a different perspective and a very useful image for that particular week. Now let's take a look at the question and answer it together. The profiles shown are all volume-based profiles. Again, I mentioned to you that I prefer to use volume-based profiles, and so you will find that my charts will all be volume-based profiles. Does the last week VPOC, volume point of control, and that is this level right here, does it appear to be a level of support or a level of resistance? Well, let's take a look at what happened when prices came to that level. They dipped below, came right back up, dipped below, came right back up, dipped below, took it higher, and we came back to test it here. It pushed it right back up. So far, that volume point of control has been a strong level of support so far. That's not to say it will be a support level forever, but at least on this chart it certainly is a support level. Now, why are we using the 10-20 minute time frame? Again, I emphasized the point in previous lessons that selection of the time frame is very important relative to the instrument that you're using. The 10-20 helps me to break up the evening and the day sessions on the ES Mini. That is why we are using the 10-20 candles for each of these weekly sessions. Okay, another interesting question. Why is the 1866.50 an important level on this chart? Well, let's take a look at it and see. Where is it? Well, it's right here. It was in fact the high of the week that preceded this week we just finished. Your highs are always very, very important. Not only that, take a look. If we look here, this was an area of very low development. So in this week, we sailed right through it and it took prices higher. But in the prior week, look at what happened. This was a resistance level and prices dropped down here, down to this level, and then they continued lower. So probably there were some people that in fact may have been short in the market at this level and stayed in it, but look at what happened to them here. The market started moving back up. So if the market comes back to visit this same level and you have some shorts that were trapped here, what are they likely to do? They're likely to be buyers to cover their shorts. What will that do when they come down here to buy? It will push prices higher. And so this is an important level in the market that may come back to get retested. And we know that there is a potential for the presence of trapped shorts in this area at this high. There were a number of people that shorted, and we can see that, and prices did drop, and we had a significant gap here. And if they didn't get out of their shorts when the market started moving higher, they were anticipating prices to continue lower. They are trapped. And that is what would happen when prices would come back to this level. All right. Now, where is the most recent price level of resistance for last week on this chart? The most recent was right here. We had some selling, and take a look at the after effect of that selling. Prices continued back down lower, and they came right to the volume point of control, found support, came back up. So here's our latest level of support, and there's our most recent level of resistance. The most recent 10-20 period on Friday's session closed below the 5 simple moving average. Here's my 5 simple moving average, and yes, we did close below it. Is that a bearish sign? And the answer is yes, it is. Whenever we close below the simple 5 on a 1020 chart, that is a bearish sign. And if in fact we close above it, as we did here, that is often a bullish sign. So what does this really tell me? Well, it tells me that the scenario or the projection that I made a little bit earlier, that prices may come back for a retest of the support level here, or this potential support level down here, is very realistic. That I shouldn't expect prices to shoot up immediately because of all this bullish momentum, that there is a potential for a rotation to the downside. And I learned that by looking at this bearish development here. So yes, we have one session that closed bearish towards the high. That does not negate the activity of the full week or the trend. It simply alerts me to a potential retracement in the market. Now, notice what actually happens after this. This was the candle where we closed the week, and this was the subsequent activity that took place after that. Take a look at what happens. Well, the next candle dropped lower, came right back to the developing volume point of control. Now, the following session actually dropped even lower, and notice right where it came to. Okay, the level that we described earlier. So it is actually following the projections that we had discussed and made earlier. The buyers were still here and they pushed prices higher. We close above the 5, we get back into bullish sentiment. But what happens here again, when we get up to this high, we're not able to sustain it, and we come back to this level here, which is the volume point of control. We find support, we go back up. This tells me that the market is not quite ready to move higher yet. It needs to consolidate its support, and we may in fact see a rotational market for a number of sessions in this area before we move higher. Now, notice again, I want to re-emphasize the strong support that we had here that coincides with both the high of this week, that 1866.50 level that we were looking at from the prior week, and the valley that existed here, which was again an area of support, and it continues to be an area of support. You notice here it pushed prices higher, and that buyer obviously is still in this territory. Well, when we come back again, will they still be here if we come for another test? Well, we won't know the answer to that unless we see what happens in the market, if in fact prices come back to visit that point again. All right, now we've completed our review, and I would like you each week to be looking at the market using the tools and the analytical techniques that we're discussing to determine your projections for the market that you trade. Now, we're going to switch gears now and get to the topic at hand for this lesson, which is footprint charts. Well, what are footprint charts? Footprint charts are a feature of Market Delta that is the only platform that I'm familiar with that uses footprints. And as a matter of fact, I think they have trademarked that name, so I don't think there is anybody else that uses it. But what are they? Well, footprint charts really provide us with detailed data and information about market activity, as you will see with me here. This is what is described as a basic footprint. Well, instead of looking at a candlestick, I'm looking at a rectangle with shaded colors in the background and numbers on it. And these numbers are details for that period of time, and each of these rectangles, or bars if you will, happens to be a 30-minute period for the ES Mini. It could very well be a period for a stock, it could be an ETF, it could be another future, but the important thing is it is traded on an electronic exchange that can offer this data. Forex gives you some of this data also, but the problem is in the Forex market there is no central exchange, so the accuracy of the data is often in question. If we take a close look at each of these bars, rectangles, or footprints, as Market Delta calls them, we will find that each of them has a number on the right-hand side and a number on the left-hand side, separated by the letter X. Now, all of the numbers on the right-hand side are really all the trades that were conducted or transacted at the ask. So all of the numbers here on the right side are the cumulative trades that were transacted, completed at the ask at these price levels. And if you trace back here, it would tell you the exact price level at this particular candle. Similarly, all of the trades on the left-hand side of the footprint are the trades that were traded at the bid. Now, there is a general assumption that is often made that trades that are made at the ask are made by buyers, and that trades that are made at the bid are done by a seller. Now, in many instances, that is really a false assumption. So be very careful with that, assuming that all the trades at the ask are really buyers and all the trades are the bid are sellers. There are many times in the market where, in fact, buyers will put a limit order and will buy at the bid. They are responsive buyers, and at the same time, there are responsive sellers that will sell at the ask. So be careful with that gross generalization. It's often used, but it can be tricky. So let's for now consider trades at the ask, just the numbers on the right-hand side, trades at the bid at the left-hand side. And we will talk about how we can determine whether these numbers represent sellers or buyers in great detail when we begin to look at the actual outcomes and the impact of the transactions on the market. That is the best gauge. That is the best way to find out whether these trades were made by buyers or sellers, and not to just assume simply because a trade was executed at the ask, then those must be buyers, or if a trade was executed at the bid, then we're making the assumption that those were sellers. So always remember, buyers do in fact frequently buy at the bid, as sellers frequently sell at the ask. Now, you will also note on the chart different gradients of the two colors green and red. The intensity of the color is used to indicate the level of total volume activity at that price level. So if we look here in this bar, this is the darkest red color on the bar, and it in fact has the highest level of activity within any of the price ranges on that bar. Now, why red, why green? If in fact the number of transactions at the ask are greater than the number of transactions at the bid, the assumption, and again, special emphasis on the word assumption, the assumption is in fact this was a buyer transaction because of the a large number at the ask. And so it gets the color green. And similarly here, because we had a significantly higher number on the bid side than we did at the ask, the assumption, it's red because of the seller. So now you understand the intensity of the color and what is that intended to show visually. So if I see intense red like that, I would anticipate prices to continue lower based on those assumptions. But you will see there are instances when that actually is not accurate or true. Now, we can also display many different types of numbers on this footprint. It all depends on our strategy and what we want to look at. So again, in our first lesson in introducing the footprint, we're just going to look at some of the basic capability, and we'll also take a look at how we use this capability. And there will be many other items on there that many options to display data and details that I personally don't use, and you're certainly welcome to research and try them on your own. But sometimes data can be overwhelming, so I like to focus on data that is relevant to what I'm doing and useful, rather than just sort of looking at data for the sake of looking at lots of data. All right. Now, here we have total volume at each price. So instead of a bid and ask, it's simply a lump sum number at each price level within the range of the bar, what the total volume was. Regardless of whether it was traded at the bid or the ask, this is the total volume. And again, one color, the blue, and the intensity of the color indicates intensity of volume. So right away, your eye would focus here on the area in this bar that had the greatest volume, because it shows the highest intensity. Similarly, that area was here. And so looking at total volume figures can sometimes be helpful and useful, and we will also look at that as one of the techniques for displaying the footprint, because it helps us to look at volume distribution. Now, a volume profile is nothing more than volume distribution for a particular trading session. In this case, the session is really a 30-minute session, so this volume distribution is really the same exact thing that you see here, just represented in a visually different manner. So here we actually see the numbers. In this case, when we look at it this way, we see bars, we see a histogram, and we see different color intensities, again, based on which of these bars had a more intense and a greater level of volume. Again, the dark colors are areas of intense volume activity. This is an important form to be familiar with, because it gives you an opportunity to adjust and customize the footprint that you are going to use. And it gives you many different options. For instance, you can show volume at price, you can show time at price, you can show ticks or trades at price, you can break down by bid and ask. It gives you a number of different options, and if you have market delta, I encourage you to experiment and take a look at some of those options. Now, here's another way to display the very same data that we've been looking at. And we are able to do that again using the features on the window that we were just looking at. In this case, what we have again is all the transactions on the ask on the right hand side, and then all of the transactions at the bid on the left hand side. This bar here is what's known as the close bar. So since this is green, this was obviously the open, and this was the close. And here, this must have been the open, and here's the close, because this is a red line or a red bar. The idea here is we shade the side with the greatest intensity. So if you look at a number that's in green, it means it was more intense than the number on the other side. So the ask was more intense here than the bid, and vice versa. If in fact the number is red, as we see here, then all these numbers at the bid were more intense or greater than, higher than the numbers that were at the bid. Another visual format to help us as we navigate in the market and try to pinpoint our entries and exits and sort of seek order flow affirmation for our trading decisions. We've just looked at a broad overview of what the footprint looks like. We haven't begun to actually employ or use them yet. We need to understand what they are before we can do that. But let's talk a little bit about how they help us and why they're useful. First and foremost, they show us volume at each price, which is really a very helpful number to look at. Is volume increasing? Is volume decreasing? And in which direction? They also help us to see the breakdown of volume at each price. We already talked about the fact that I can display the bid volume and the ask volume for any price level. That's really a breakdown of the volume at each price. Order flow, it also shows me what's happening with order flow. Am I, as volume is coming in, am I actually seeing prices move to the upside or move to the downside? And order flow is sort of, I don't want to say difficult, but it takes a little bit of time to get the knack of being able to accurately and correctly read order flow. So, and that is usually most useful for intraday traders learning to use the order flow, because there isn't much movement during an intraday move, and you want to really enter at the best price, and you want to make sure that you are coming in at the right point of order flow. If you are in fact a swing trader, the order flow is not going to be very significant for you, because you have somewhat of a more flexible margin for your entries, margin of error, if you will. Now, it will also show us the number of ticks or trades at each price, the footprint, the time at each price, and the delta at each price. So all of this data can be useful and can be helpful depending on the strategy that we use. We're going to begin now by adding our valuable profile tool to our footprint chart. So all of a sudden now we've added another dimension, and we're going to begin to see how this will help us make sense of this footprint tool. Here I have a 1020 profile, so it is for the day session. Here's the high, here's the low of the session. You can see 1020 gives you the duration of the session, or the profile that we have on there. And you can see that this is really just the start of the day. We have the first 30-minute period, second 30-minute period, third 30-minute period, and then the fourth 30-minute period. So periods A, B, C, and D on the profile. Now, as we begin to read order flow and use it, you will see that the profile will be a very, very valuable tool for us. But there are also other things that I want to introduce to help us get an even clearer picture of what to look at and to see what is happening in the market. Candlesticks in the background. Now notice, once I've added the candlesticks, since the candlesticks happen to be a very familiar way to look at activity in the market, I find that people like them, like to see them. So right away here, we can see that from the profile, this was an area of heavy volume activity. All right, and we can see what happened after this heavy volume activity. Look, we see the activity here on the profile, and we also can look at the value area low from the prior session, and here is the value area high from the prior session. Okay, let's look at how prices are reacting. We dropped down, but we came right back up, and after this intense volume activity here, which probably included both periods, we find that prices push higher. So certainly, as I begin to observe that and I begin to see all the green on this right-hand side, I would feel a lot more comfortable about a long entry somewhere up here based on what I'm seeing as far as intense volume activity and order flow to the upside. And sure enough, it continues, and you can see how all the green up here continues and continues to move higher. Now, when this period closes, this 30-minute candle closes, why would I decide then to get out of this entry and be somewhat leery or reluctant about continuity? Take a look at how little up here activity I have and how the activity is actually decreasing significantly from what it was down here at this level. So the market isn't facilitating trade to the upside in this candle. So when I close down here and I take a look at the high, I would be somewhat leery and about continuing. And if I wanted to know if in fact prices were going to continue higher or not, I would look at this high volume node that appears on my profile and see what is really going to happen when prices come back to visit it. If prices see additional volume come in and we continue higher, I may be comfortable coming back in with another long. But if in fact I see volume dwindling, as I do here, I would begin to get bearish. And certainly if I am in a long trade that I initiated down here somewhere, I would be getting out of that trade and waiting to see what the outcome of this candle will be before I do anything else. So this is just sort of a brief overview of how we begin to use these tools. Now I'm adding some additional technical tools, some very simple ones. I want to take a look at the volume point of control for each bar, and that is the level that has the greatest volume for each of my bars, and each of these bars happens to be a 30-minute bar. I want to take a look at where those are, and they're very easy to spot. Here they are. These are all my high volume nodes. Now, the other thing I have are my simple moving average and the 20 simple moving average. Now, take a look at when we were up here, and what did my 20 simple moving average look like, the slope? If you notice, it was really lying pretty much flat. Yes, the 5 was heading higher, but the 20 seemed somewhat dormant, which was consistent with what I observed as we ended up deviating away from value above the value area high, and I saw that the volume levels were starting to dwindle. Some additional telltale signs or clues that help us when we trade. Again, very basic, very simple tools, but yet very effective. So when I see this in terms of how it is moving, and I also take a look at the volume as we extend beyond the value area high. And remember that concept that we introduced in earlier lessons, that opportunities in the market exist often when price deviates away from value. And we see the deviation up here. We're above the value area high. We end up closing below it. And the question is now, is the market going to facilitate trade higher, or is it going to take us back towards value, maybe even for a retest of the value area low? And in this case, the answer in looking at the order flow becomes obvious to us very, very quickly. We open here below the value area high. We make another attempt at going through the value area high, but take a look at the volume levels that we get up here. 176 tops, and then we start dropping. Once I begin to see these large numbers that are even greater than the numbers that preceded me on the bar up, and prices are dropping, I'm a seller in this market, or I would be comfortable taking a short. So that is the process of how we read order flow. But again, the profile helps us in terms of identifying the key points that we really should be looking at and understanding profile concepts, just this very simple concept of what happens when prices deviate away from value. Helps me to identify the trading opportunity, and the order flow just becomes another tool in my toolbox to determine whether I want to enter long or short. And it is a very active tool. It's a very rapid tool, so it doesn't take a lot of time. I observe the activity as it happens in real time, and I need to decide quickly on what to do. Now, here I'm going to introduce another technical indicator, which we will talk about, we'll spend some time on again in other lessons. It's the KVT, or the Kepler Volume Tracker. The basic idea behind the KVT is it is very helpful for us to know what the prominent or heavyweights in the market, or smart money, if you will, are doing in the market. And our first challenge is to identify when they participate in the market. That's the first challenge. And then once we have been able to identify the when and where they participate, we want to know which way are they going, which way are they trying to move the market. And so in this case, I took off the profile off the chart just to show you how the KVT alone could help us in making those types of determinations and detecting direction of the market. Notice here in this case, I have a red dot, and here I have a green. Well, what the KVT has detected is what we call level 1 and level 2 volume levels. Level 1 basically is an intense level of activity above the average, and level 2 is a twice as intense level of activity above the average. So the red is not necessarily negative by any stretch of the imagination. It just means there is more intensity in terms of the increase in volume. And this is lower intensity. So let's take a look, but in both cases, this was heavy volume. This was a footprint, if you will, of a giant. The giant was in the market. Now, what did the giant do when they came in? Well, take a look at where prices went. Did they continue to drop below? No. They started to move higher. So obviously, even though all these numbers were red, this was buying activity. And these buyers prevailed during this 30-minute period and continued to push prices even higher yet. However, we had some intense activity here, and take a look at what happened when we came back to visit this activity. Did this prove to be a level of support, or did it in fact continue pushing prices lower, meaning that this was a seller here? Don't want you to mistake the color red for thinking that the KVT identifies a seller and a buyer. That is not correct. The KVT merely identifies for us high levels of volume. So what does it do? It goes back and looks over a period of time. During this same exact time period, what was the average level of volume traded? And then it examines price levels that deviate from those averages. And in this case, we had a significant deviation from average here. And in this case, we had twice as significant deviation from an average here. So this was a deviation that was 2 standard deviations higher. This was 1 standard deviation higher from the average. So take a look now what happens. As prices drop, and they drop below a KVT level, I am a seller right away, because I've now recognized or realized what the smart money was doing. They were selling here. All right, and so prices continue to drop. Once again, I begin to see 1 level 2 and 1 level 1. And we will talk next lesson on how we adjust the settings in the KVT. But now I want to focus on what it tells us and what and how to use it, and then we will look at the settings. Again, order flow and this type of detail requires time to digest, requires practice, and so we will be visiting and going over it a number of times. But since we will be using it to determine our trade entries and to help us with our strategies, I wanted to introduce it to you fairly early on. Now, notice here again, intense volume. What is the outcome of this activity? We continue to drop lower. If we are below, certainly below the low here, and I have smart money here, I am a seller right away, and the market continues to drop even more. Now, let us take a look at the KVT, and now, in addition to having the KVT on the chart, I've also included the profile. So take a look at some of these levels of the smart money and their participation and how they begin to correlate with our profile. Up here, the intense activity came in at the value area high of the prior session. Notice this was our value area high, and it extends through here. This is actually the value area high of this session, the line above it. So it came in here, and this was probably selling activity. And believe it or not, even though all this looks green to you, it probably was this very same seller continuing to sell to all those eager buyers who actually ended up being on the wrong side of the market. So the smart money was selling here, and I don't want to say the not so smart money was buying, because take a look at what actually happened in the market. So even if I were a buyer, I don't want to be trapped up here. The minute I begin to see this development and I begin to see order flow change, and this is the power of the order flow, then it behooves me to quickly get out of the way and adjust my trading position, either exit or take my profit. If I was long from down here, order flow is incredible that way. It really helps us to respond and respond quickly if we can understand it and if we can read it. And this is why I want you to begin focusing on it and understanding what's happening. So if you notice, all these greens here, all these asks, obviously somebody was selling, somebody was buying. All these contracts that were sold here, all the individual or individuals or entities or whomever that bought them, what are they doing now when we start to see prices fall? Well, certainly some of them probably will close their positions, but remember, there are some that are going to get trapped, and they've trapped some longs up here. Keep that in mind. Certainly you never want to be one of those, but it does happen, and longs do get, unfortunately, trapped. Now, we drop and we continue dropping. And a mistake many traders make is they tenaciously hold on to a position because the loss is painful. They don't want to take the loss. And that's why, if you understand order flow, and if you would have seen a KVT and me taking out a KVT and you're still in this trade, you really should not be trading anymore. I mean, you really should rethink your whole strategy. You don't understand what's going on in the market, and you're going to get trapped, and your losses are going to continue to mount. And that's what we want to prevent, and that's what we want to avoid. This is what gets a lot of traders into trouble. Some will describe it as psychology. I often tend to describe it as not understanding the market. And once you begin to understand order flow and you see that the flow is not in your direction, why are you still in a long trade? You need to pull that plug on that trade and pull it as quickly as you can. And you can also see it not only from order flow, but what's happening relative to the profile structure. We're at a value area high. We ended up going above the high. We get rejection of prices. We're going to move back towards value. Why would I be stuck up here in an area that was rejected and wasn't going to move higher? Why not just get out of the trade, come back in, And if prices rotate, come back up, I'll come back up with them. In this case, prices continue to move lower. I get heavy participation again here. And sometimes this may be a cue for me to actually exit because I don't know what the outcome of this heavy participation will be. It could very well be that these folks are going to turn the market around, especially since this is what happened here. Just a short while ago, this heavy participation came in and pushed the market higher. Is that buyer still committed here? Obviously they were, and the activity did come in, but the seller overtook them. And I am not able to predict that or to anticipate that. So what would be much smarter for me is to stay on the sidelines until I have a clear indication of the outcome of this intense activity. I'm not a big player like these guys. I'm not going to get in their way. And the minute I begin to see prices dropping below this level in this next bar, okay, I'll come in. So I may have missed a point or two out of the trade, so be it. But at least I'm staying in the direction of momentum, I'm staying in the direction of order flow, and I'm not fighting an uphill battle. Prices continue to drop, and they drop lower. I don't see any big participation back in. So all the way through here, we get down to the value area low. This could be a point, an area where I may in fact reduce or take some of my profit. I may choose to continue to stay in the trade because I still haven't seen any heavy hitters come into the arena. Those are judgment calls one would make, but nevertheless I grabbed a couple of points heading down. And intraday, that is usually a reasonable goal to grab. If you can grab a couple of points here, a couple of points here, especially during a day that does not look like a trending day, and you know from the get-go this is not trending. Whenever you see the simple moving average and the 50 moving average parallel to one another, so close together, that is not a trending day. If anything, now we're starting to see the beginnings of a potential trending day to the downside, and certainly not the upside. So I want to look at all the different parameters. I want to look at order flow, and order flow is affirming to me what my moving averages are also telling me. So when I get a confluence of evidence, I should pay attention to the overall market activity and stay on the right side of the market. As a momentum trader, you want to be with the momentum. You never want to fight against momentum, because if you do, more often than not, as a matter of fact, always you will lose. Never fight momentum in the market. You want to be with the direction of momentum. Now, I've added one more element that we didn't have, that again I wanted to introduce in this lesson. Another helpful element, if you will, that comes as part of our profile tool, and that's the developing point of control. First of all, early on, this is where my point of control was. And then my point of control, meaning the price level that had the greatest intensity of volume, jumped and was up here. Now, when prices were rejected up here, notice what happened. Prices continued back lower, and we came right back to the old volume point of control. Now, we are dropping lower, and if in fact the market continues to find value lower, I would anticipate for this developing volume point of control to continue to drop. But notice how it becomes a level of resistance up here. So if prices come back for a revisit, this is going to be a key level of resistance in the market, because this was again a level of high intensity of volume in the market from this particular session. Notice, looking at order flow, we're looking at profile development, we're looking at market activity in real time. That is the process of analysis, or that is what a profile trader does. And notice how understanding the concepts, using the right tools, the combination helps us to identify opportunities. Look at how many different opportunities we were able to capture. We were able to capture a long very quickly here. Once this came in, it gave us a warning signal, but prices shot up higher. We could get out. Even if we get out, once we begin to see this candle start to drop, let's say we get out here, in this trade we comfortably had about 3 points. Once we take out this intense level here and we start to drop lower, we have a short trade. We're sellers. We continue to drop. I begin to see this intense activity. I exit. I have at least a point and a half, possibly 2 points into this trade. Now, prices continue to drop even lower. We take out this low. I'm back again in as a short. Prices continue to move lower. I could exit here. I could potentially exit here as prices come back up. I've got another point. So comfortably, just during the first 1 hour, 2 hours, 3 hours of the market, I have pulled out about 5 points out of the market, simply by staying on the right side and not trying to take the market where I want it to go, but really moving with the market where it wants to go. That is the key thing that I would like everybody in this course to take away from this course. Our objective is always to identify where the market is going and to be on the right side of the market, not against the market. And the minute I start to get an indication that I am on the wrong side, I should have the discipline, the intelligence, and the speed to get out and remain on the sidelines or get back in on the right side. Never hesitate to take a small loss. That is the best time to take a loss. If your losses start to mount, that's how you blow your accounts. So keep that in mind. On all these tools, the whole purpose of all of these tools and techniques are to help us manage our risk and to always stay on the right side of the market. All right, with that advice, I am going to conclude our lesson for today. And as always, I will wish you the very best of luck with your trading activity. Feel free to forward to me any questions that you may have. I'm always delighted and happy to address them for you, and I'm hoping also that you are pleased when you get my answers. Do your homework. Apply the stuff. This is the best way to learn, to actually apply the knowledge. So good luck, and we'll see you in the next session.